Does that make sense to everyone? Okay, let's go to the final innovation. This has to do with NEoWave confirmation, self-confirmation. This is where the market determines whether you've done your homework correctly. You don't have to ask anybody. It's not up for debate. It has nothing to do with opinion. You can arrive at these conclusions very objectively, and it's sort of like grading your paper. Whenever you finish an impulsive formation, upon the conclusion of the fifth wave, whether it's going down or up, it doesn't make any difference, there's two stages of confirmation that are required to guarantee that that analysis is correct. Stage one is when the market breaks the trend line drawn across waves 2 and waves 4, or wave 2 and 4. What needs to happen, it needs to break that trend line and touch it or break it in less time than the fifth wave took to form totally. So the fifth wave took 5 days. You need to get down to that 2-4 trend line in less than 5 days. If it takes more time, your count's wrong, or wave 5 is not finished. Okay, there's no debate about that. This is an absolute, guaranteed, 100% workable. I've never seen an exception to this in 14 years. Any questions about this? Second stage of confirmation has to do with when the fifth wave of a pattern is completely retraced. This is the clincher, you might say, to your wave analysis process. If you get this second stage, the probabilities of accuracy approach 95 to 100%. At stage one, it's more in the 70-75% range. There's still some things that might happen which would alter the accuracy of the situation. Once you get both stages of confirmation, you can rely almost 100% on that analysis. You can lock in this structure as a 5-wave move, never to be changed again, and then go on with the next part of your analysis. Question? No, that this has to happen. The indication that that is an actual, absolute, completed 5-wave move is about 70-75%. When it breaks this level, then it's basically 100, as close as you can get to 100%. So in other words, these events have to happen. If you don't get stage one, your count's definitely wrong. Then it's still in the 75% range, and you have to consider other possibilities to be safe, but you don't know for sure. The only stage 2 gives you that absolute confidence. Yes, same as stage 1. You have to reach the beginning of the trend in less time than the fifth wave took to form itself. There's another parameter here that I didn't mention. It also has to do it in less complexity. So if wave 5 took 5 clear subdivisions, you have to get to the beginning of wave 5 in less than 5 monowaves. So if you have 5 monowaves within wave 5, the reaction to start the new trend has to be 5 or less, preferably 3 or less. So these things, I guarantee you, always work. And I think some people in here have taken my class before, I assume. Has anybody taken my personal training class over the telephone? Oh, I guess not. They're quite frequently amazed that you can explain price action to such an incredible degree of specificity. You know, talking about exactly how far a market needs to go, how long it needs to take to get there, how complicated it's going to be going from point A to point B, and it just doesn't seem logically possible to most people. But when you go to all the trouble to do the things that I'm talking about, it does become possible. Yes?
How does NEoWave address the rigid rule that the bottom of wave 4 never exceeds the top of wave 1?
Oh, that's an absolute rule. That's an Elliott Wave rule that occurs before NEoWave. That's definitely. Nothing about the old orthodox approach have I changed. So all the standard rules are still there. I've just added on top of that to make it more scientific. Any questions? Okay, same concept applies to corrective patterns, but frequently, because of the way corrective patterns move, the trend line and complete retracement are at the same point. So you sometimes will achieve stage 1 and stage 2 simultaneously during flat corrections or sideways market periods. Not all the time, but sometimes. If it's not, if the trend line is not horizontal and you don't achieve that confirmation at the exact same point, then the same rules that applied here apply here. You still have to get to the trend line in less time than the last wave took to form. It has to be less complicated, and it has to reach both the trend line and the complete retracement within that time frame. Okay? Okay, let's show some examples of this on the next chart, page 28. If you were looking at this chart which a lot of people might come up with this analysis. I'm not sure. Probably more people would put wave 2 here than over here. But if you had wave 1 here, the problem is that the reaction after wave 1 is over is too tiny, and the recovery is too severe to indicate that your trend really terminated with the first high. So an event like this, if this really is wave 1, you'd have to move the termination of wave 1 to the right. You never want to have, I didn't mention this earlier, but you never want to have the initial reaction off of a higher low retraced more than 61% if you're going to consider it the start of a new trend. So this extreme recovery after the initial drop indicates that this has to be the start of the new trend, the high to the right, not the highest point, because the reaction after the initial break is too severe. That means the market really isn't trending yet. It's still working on finalizing the uptrend before the new downtrend starts. And notice by taking this approach, your trends always start with a nice, quick kickoff, which allows you to begin solidifying specific kinds of behavior that always occur from the very beginning of a trend. And if you don't do this, like I said earlier, you may have action off of a higher low that sometimes produces this action, sometimes it doesn't, and the behavior just isn't reliable if you don't determine exactly where the new trend started. Yes?
What about, in opposition to that, you often get a situation where you look at one there and the next high goes higher, but in oscillators you get divergence. There's often a good signal for a high looking at oscillators, and yet it wouldn't certainly go on more than that 61%.
All I can say about oscillators in general is that you need to realize that most technical approaches that are relatively simple mathematical approaches identify market behavior. They're not really identifying overbought, oversold, support and resistance. They're identifying a certain type of behavior. And that behavior falls into the two classes of Elliott Wave or NEoWave, impulsive patterns and corrective patterns. So what frequently happens is that when you have a powerful move up, the market reacts, you get another move up that's much slower, and it's part of a correction. It'll indicate that the market momentum is slowing down, you're reaching a top. It may be a top for a long time, it may be a top for a short time, and you may get a little reaction and start another huge trend. It's hard to say, but what it's identifying is corrective action, and it can be very deceptive if you don't know whether that corrective action is concluding a trend or is part of a drifting upward pattern that is eventually going to be followed by a much more powerful advance. Does that make sense to you?
I was referring just over one, just that little blip up there.
Uh-huh.
Did I understand you say that that little blip up after one, that can't go beyond 61%?
Right. The first reaction, and then the question is that the market broke down from the high, and then it retraced more than 61%. That event tells you that the real downtrend hasn't started yet. The market's recovering too much of a decline to say we've started a real new trend. So if you don't define what constitutes a trend, then you're not going to be able to use all these techniques that we talked about and really regiment your approach to a point where everything constantly is behaving the same way. Most people are always used to having to make exceptions all the time to behavior. I don't have to do that with this approach because it forces everything into specific kinds of behavior based on using the right kind of data and all the things I've mentioned. Okay, the other problem here, if you notice the end of wave B, the market broke down again, retraced too much before it really started trending. And if you were to draw any trend lines, you can see that this low here did not break any previous trend lines. So there was no confirmation of the conclusion, which means wave B should be moved over to this point. That's where the trend actually started. And the retracement is close to 61. I don't know exactly. What?
C started over in the second.
Yeah, C would start here along with the conclusion of wave B, not at the higher point. Okay? This is a big problem for most people because almost everyone wants to terminate patterns right at the top, right at the bottom. If you do that, your analysis will just never be consistently accurate under wave theory. If this, wait, say that again? This here? This is fine. Yeah, the reaction is violent, it's fine. There's no problem with wave A. You notice how it quickly moved up, didn't retrace too much, and continued. Because the initial reaction is retraced more than 61%, indicating you hadn't started a new trend. And because if you drew a trend line across these lows, which is an important way to determine conclusion of patterns, you have the decline here, and the market retraced more than 61% of the initial drop. Okay?
So does that mean that we should expect the market to still go higher after C?
Oh, absolutely, yeah. The minute C is finished, first of all, when you have a B wave or a pattern that makes new highs during a correction, that's a sign of strength. We haven't gone into force in the application of what you might call NEoWave force, and we won't go into that today. But force is an indication based on market, the market's trend and how powerful it's going to be. You're going to recognize this in the way the market behaves. So based on the B wave making new highs here, that's telling you in the future the market's going to have a very powerful uptrend. That's an indication of future force, and that's why the correction is drifting upward. But a lot of people would determine maybe this is the third wave or the C wave of an ABC or something like that, because they're not carefully analyzing the structure and they're not allowing enough time for the corrections to take place and so forth. So just as a general rule, remember when you make new highs during corrective action, the correction's not over, but you've made a new high during its formation, that's a sign of futures market